G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host David Shih. Together with me as always is John Comino. John, how are you doing, mate?
Hello, David. I'm really well, and happy Friday to you, sir.
Happy Friday. Likewise, mate. Always love a bit of a good chat about property in regards to what's been happening. And there's been a lot of moving parts as always, right? In 2023, and I think everyone is very confused about the fact that we are seeing a price increase steadily phenomenon versus an interest rate increase phenomenon, and with more potential rate to rises to come as well. So it's just one of those things that, I don't know, we were talking off air. It's like as if like never say never type of scenario at the moment. You would have thought that 12 months ago, if you're telling us that you're going to have an interest rate sitting at, or official cash rate sitting at 3.85 in 12 months, plus an actual positive figure going very strong with property gaining momentum at the moment, I don't think anyone will believe you.
Yeah, it's strange, isn't it? Look. We do obsess over what interest rates are doing, and real estate's a very very interest rate sensitive asset. But all the powers that be require some sort of inflationary appreciation in real estate over time. So I think real estate's. I mean, I was in a discussion with another guy about whether anything has changed in real estate, and I think real estate is just doing what real estate does. It's probably going to double every 12 years, like it kind of always does, and interest rates are going to go up and down. So maybe we're not living in particularly unique times, but other than the inflation, which we'll come to.
Yeah, no, that is true. That is true. I guess we will uncover that through our June Corelogic data, which was just released hot off the press. So we'll touch on that. But before that, look, I think the other biggest piece of news that came out literally just yesterday was the April CPI data. So the Consumer Pricing Index, in other words, measurement of essentially the inflation monthly figures.
Yep.
So April inflation is sitting at currently at 6.8%, which is, I think the expectation was around 6.4 from memory, if I'm not mistaken. Yeah, so it came in higher than expected. And mind you, our listeners, the March CPI data was sitting at 6.3%. So it was actually a jump from 6.3 to 6.8%. But I think this is where the narrative gets interesting. Because if you look at the headline figures, you might go, "Oh crap! This is looking bad because we are going back up again." But not until you get into the devil of the details, you might be able to find some interesting trends. And I know, John, you did a bit of work in looking into it, basically in terms of extrapolating why there was a jump, or why of course potentially a jump. Do you mind sharing that information with our listeners in terms of why it's probably not all bad news?
Yeah, so there was a little bit of a quirk in the April numbers for 2023, and so the biggest movers were fuel and rents, right? So rents were up about 8.9%, and fuels were up about 7.9%. But the fuel number is a little bit misleading, and what the reason for that is that in 2022, in April 2022, a year ago, they removed 50% of the fuel excise. So they dropped the price of fuel, and then they reinstated the fuel excise in October 2022. So between April last year and October of last year, the fuel excise went back in. And because we're looking at a 12-month period from April to April, all it's capturing is the reinstatement of the fuel excise. And so what it's doing is it's pumping up the cost of fuel, the retail price of fuel. And my guess is we'll need to get to October 2023 to fully flush that out of the system. So we need to lap that fuel excise cost, because actually fuel costs have been coming down over the last 12 months.
Yeah.
But because they've put the fuel excise back in, it's not really being reflected in the CPI. So that's a quirk. The market didn't like the CPI number. It did surprise, as you said, so they were expecting it to come in a bit lower, and it sort of bounced back up to the February number of 6.8%. And look, it's made the market, I think the ASX was down 200 points or something that day, and it made the market rethink interest rate expectations. So the RBA are meeting on Tuesday next week, the 5th of June, and the odds have gone up that they might unwind the pause. They might need to put rates up again. So that's always the danger. But look, if they read that fuel excise wrinkle into the numbers, and I haven't seen anyone strip that out, but maybe the CPI wasn't so bad if you account for that excise adjustment.
Certainly wouldn't be sitting at 6.8% if you put that into a consideration. But having said that, I'm sure the smart brains in the RBA, hopefully they will be able to spot this information and be able to make a appropriate call in that sense, whether to take into account of the, as you said, the fuel exercise, which was it 50% essentially? So they kind of like halved the fuel cost, isn't it? In that.
Well, it was half the excise. I'm not
half the excise, okay.
Percentage of the total fuel cost it is, but I think like most of what we pay at the pump taxes, so it would have been a reasonable chunk.
So the way I'm understanding it is basically it's like a manual intervention from April to October last year, because they're aware that the petrol prices have gone too high. The Morrison government stepped in to help people by making petrol a bit cheaper, essentially, and that's why at the moment when we compare to a cheaper fuel prices last year around this time, it's hence the reason why it had a jump of about 6.9%.
Yeah. But don't forget rents. Rents are there's no distortion there. Rents are 8.9%. So the annual, and these are national figures too. So if and it doesn't sort of break it down by property type, but rents are broadly speaking up about 10%. They were going up before April last year. So if you would look at a 2-year figure, they're probably up 20%. So cost of living's certainly higher. That said, the cost of the increase, let's say the cost of rent has gone up by 10% over the last 12 months. For those mortgage holders who are about to have their fixed rates come off and the variable rates come on, their cost of funding will probably go up 60%. So I think the mortgage holders are probably going to see a sharper turn in their cost of living than renters, but it's affecting everyone.
It is affecting everyone. I think that's why, we've been talking about the mortgage cliff for a bit of while now. For those people who have experienced it, obviously they understand, the repayment could jump up as little as $500 to $1,000 extra per month. And where you're going to find that extra money to be able to fill in this gap in that. So, a lot of my conversations with investors have been, whether it's big portfolio owners or small portfolio owners, some of them are considering if they're not able to hold out due to the cash flow issues, they will have to be selling. That's just unfortunate way of looking at it. And as you and I discussed before coming on air as well, John, if you haven't held the property long enough, then there's probably not enough equity or enough gain to be able to justify that sell. If you don't, and you might have to make a call to say you might have to sell one of the earlier properties in order to make up in that scenario, which no one wants to do. But the reality is, that jump in repayment is going to kill people's cash flow. That's just what it is. Like I can't even, in current scenario, I can't even refinance people out to interest only, even if people wanted to. Serviceability is the issue. We still have the 3% buffer right now on APRA at the moment. So it's going to be, the way I look at it, John, even though there's not a lot of stress sales on the market, I think it's actually quietly ticking up. I'm seeing, and this is probably a good segue for us to talk a little bit about what we're seeing at the moment in the market, right? So I'm seeing a lot more sales agents advertising us off market. They want quick, fast transactions. Now, so that's probably some part, some sellers will probably don't want to go through the marketing fee, which I can understand. And there's a lot of demand at the moment with not a lot of stock. So that off-market type of strategy could be a way to be able to sell at a good price. But at the same time, the sales agent's not going to tell you, oh, it's a fire sale, mate. The seller's actually struggling. But the off-market number of stock is starting to increase in comparison to what I'm seeing maybe 2 or 3 months ago. I don't know what you're seeing, John. What do you think?
I'm not seeing that. I mean, I see off-market properties all the time.
Yeah.
But what certainly what I've seen very recently is because there's no stock and selling agents are trying to manage properties, but also trying to manage their own brands. If they sell too much off the market, they can't have the for sale sign out the front with their picture and the company logo on it. So I was doing some work recently where the agents wouldn't sell off market only because they needed the for sale sign to go out the front.
I see.
To get some marketing out there.
Branding.
Yeah, some branding out there. So normally in a market where you've got reasonable supply, they can do a mix of off market and a mix of on market. But at the moment, and we'll come to the Corelogic data, but volumes are down 25% over the average of the last 5 years, and the average of the last 5 years has been very low. So there's no stock, so I'm not seeing everyone wanting to do off market.
Got it. Okay. And look, if the theory here is right, in the sense that there's going to be a lot more fixed rate mortgage cliff coming off in the second half of the year, where people will feel the pinch, then there will be more supply that's coming on, not because of people wanting to sell, but they may have to sell, which would then mean there'll be more stock available, and prices may soften a little bit in terms of that. What do you think, John?
Yeah, I'd say if I was going to buy, I would not try to predict what was going to happen in the market yet, because almost every prediction has been wrong. No one thought that prices were going up sharply this year. It's happened, and not that many people predicted that they would come down last year either. Parking, I don't think you should bother forecasting and just buy when you've got finance. I'm nervous about the talk of cliffs. Like I personally will be impacted by the fixed rate cliff, and I think it's meaningful. I think that a lot of people will be affected.
Yes.
But we've been hearing about cliffs for a long time. There's all sorts of cliffs in the past, and they've never quite materialized. So I don't expect a big. So here's the reason I don't think that there's going to be a big increase in supply once the variable rates kick in.
Okay.
A couple of reasons. One is that the LVR of the entire Australian market, or the Sydney market, is about 23%. So there's not that much. So a big chunk of people who own properties own them outright, and they don't have any debt, and they don't care if interest rates double. They won't. It won't affect them. The second thing is, of the people who have debt, it's only really owner occupiers who are going to feel it a lot. So we can say most investors are going to be okay. And then within the owner occupiers, it's only the people who bought in, let's say, the last 5, 6, 7 years that are going to be really impacted. Because if you bought a house in 2006, let's say, I'm just making the number up, you've had nearly 20 years to pay some debt off. So you'll be okay too. So I think that the people who are going to experience some pain, and it'll be someone like me, there aren't that many people who are going to have life-changing pain from the reset of mortgage prices, because there's not that much debt as a percentage of the asset values out there. I really think it's going to be the people who got in last. They're going to have pain, and owner occupiers, not investors. But I could be wrong.
Oh, look, I partially think that you're right on that, John. But at the same time, I also think, as an investor who has, I mean, we are not even talking about significant property portfolio here. Even if you have a property portfolio, I'm just thinking, if for myself, if I was fixing myself on a 2-point-something%, and now a lot of my portfolio is coming off to a 6% investment P&I rate, and we have to pay P&I, that's a big jump in terms of the repayment. Now, not everyone obviously hold the portfolio like us in a sense, but even just a ordinary middle class, someone who maybe have 1 or 2 investment properties plus some owner-occupier debt, sure, the owner-occupier debt comes off. That's the biggest expense that's going to jump. the investment properties is probably gonna have to have a certain level of impact as well, depending on whether they're paying interest only or principal and interest. So overall, where they're going to find that money, to a degree. And I'm talking about the ones, probably not the ones with a lot of buffer, because, you know, like people have been spending quite a lot in terms of travel, accommodations, all that stuff. But yeah, that's what I'm really worried about at the moment, is the cost of living going up. The mortgage repayment has jumped up a lot. It's a double whammy for the everyday Australian, especially the middle class, which is what we're touching on. The middle class is the one that gets squeezed the most at the moment as the fixed mortgage cliff comes off. How are they going to do it? How are they going to manage? What are they going to do? Unless APRA is willing to relax a little bit and allow those mortgage prisoners to move out, which, you know, like we touched on last time, with one of the major banks coming out to try to reduce the assessment buffer, but that's only for P&I repayments. So we're not talking about helping investors. They are helping those mortgage prisoners who are locked with a high owner-occupier home loan rate, and to allow them to be able to refinance to potentially a lower interest rate. But we're still talking about 5.7, 5.8%. We're not seeing a 2 or 3 in the front. So yeah, so while I do agree with you, yes, there's a lot of people who don't have mortgages, but those people who have mortgages, they're going to be squeezed very, very hard. And what they're going to do about it, I'm not too sure, John. That's the issue.
Look, there's I mean, everyone who's worth their salt is predicting a recession in the second half of the year. So everyone is predicting. I think Jamie Dimon from JP Morgan came out and said, he said that the chances of a recession in the second half of the year are 100%. The Commonwealth Bank put a forecast out for interest rates. They said that they would start declining by Q4 of this year and well into 2024. So there's a lot of pain, I think, on the horizon caused by this. And but maybe the short, pithy answer to your question is, where's the money going to come from? And maybe the answer is you will own nothing and you will be happy. Maybe this is the answer is that we all become a nation of renters and we're just consumers. No one owns any assets, and maybe that was always the plan. I mean, who knows, right? But
yes, I could see that little.
Some people have savings. So wealthy people have buffers, and they're going to be fine. But I agree that the middle class gets always has to pay for everything.
And I think that's the biggest issue at the moment. Now, speaking of wages, or speaking of income as well, right? Like we're just also chatting off the air, because one of the things that the minimum wage has just gone up. Literally a couple hours ago, you know, the Fair Work Commission has decided the minimum wage is to increase by about 5.75%, which means, you know, about 180,000 Aussies who's on a minimum hourly wage would see a $1.20 increase. So their minimum hourly wage would go to about $22.61 per hour. Okay. Now, I know, I think it was probably earlier this week or last week, RBA Governor Philip Lowe has come out basically advising the Labor government, please do not increase the wages, because it's going to go against inflation. It's going to go against all the interest rate that we're trying to increase. It's going to go against all the work that we're trying to do. So please don't do that. Now, 5.75%, it's probably not significant, but it's still relatively high in comparison to maybe a 2 to 3% of general CPI increases, which is what they used to do. Now, the question for you, John, do you think this is going to cause that wage spiral? In other words, you know, the wages keeps going up. People's got a bit more money now to spend. They go, ooh, I've got a bit more money and I can pay. And then that's going to cause inflation to be sticky longer than it should be. What do you think?
So I'll make 2 quick points before I answer the question. The first one is that you mentioned that the RBA said, putting the minimum wage up, and all the hard work that we here at the RBA are trying to do to get inflation down. And there you go and throw a spanner in the works by putting the minimum wage up. I mean, the RBA caused inflation. Inflation doesn't come from anywhere else. And so the RBA complaining that someone else is creating inflationary pressures is like the arsonist turning up to your house with a bucket of water saying, "I'm here to help. What would you like me to do?" It's like, no,
Great
no, no. You stay away. You caused the mess. That's the first thing about the RBA sort of standing on ceremony there. The other thing is, so the answer to the question, and I'll tie my second point into this, is sort of how many people are on minimum wage and who's on minimum wage. There aren't that many people on minimum wage. It's largely young people in hospitality, generally speaking, right? So you don't get minimum wage in places like manufacturing. They've got the manufacturing generally, have high wages and so on. So you're generally talking about 15, 16-year-olds in McDonald's and those sorts of things. They're not one. Very few people are raising a family on minimum wage. It's generally young people, entry-level positions. So do I think it'll lead to a wage, fan the flames of inflation? I actually don't think it will. I don't think that there's enough people on minimum wage that will affect it. Inflation essentially makes minimum wages irrelevant. So if you've got a minimum wage of $10, but then you've got this hyperinflation, no one's getting paid $10 anymore. And this is what happened in the post-war period in the US, that essentially the minimum wage became irrelevant. But so I don't think there'll be a wage price spiral like the 70s. I wouldn't expect that. I think it's politics, really.
What if so let me ask a follow-on question based on this then. If the minimum wage goes up, then would that cause another round of discussions in terms of what other people should be getting, which would then lead to potentially the wage price spiral? Because they say, hey, the minimum wage people are getting 5.75%. The private sector should also be asking for that. The public sector should even probably ask for that as minimum as well. Would that cause a bit of a butterfly effect, essentially, to the rest of the industry, especially those unions, which are been fighting very, very hard in terms of pushing up wage for public sectors and potentially private sectors? What do you think?
Potentially. I mean, there aren't many union workers on minimum wage, but look, potentially there could be sort of sympathy strikes and sympathy requests. I think you'll probably find that in the public sector a bit more. So it definitely could have a spiral. Certainly. I mean, I think that there's also a sense that if you're going to ask for a pay rise, you've got to do it now, because everyone's talking about inflation. So I think that matters. Generally speaking, I mean, this is an unpopular view, but people tune in to Spark Your Fire for interesting perspectives. The minimum wage as a concept, it can be damaging to people on lower incomes.
Yeah.
So minimum wages are great for rich people because it's almost irrelevant, but it's actually what it can do is if you don't have many skills, which is all of us when we're starting out, and if you're worth $7 an hour, but the minimum wage is $8 an hour, you're unemployable. And that's the problem with the minimum wage. It puts a minimum price on something that is less valuable than that. So let's think about who might be struggling to meet the productivity requirements of a minimum wage. It might be people who don't speak the local language. It might be people who don't have any skills. It might be people who left school early. So I know that the minimum wage sounds compassionate, and often it is, but if you don't have the skills to meet the minimum requirement, you kind of just get left behind and society moves on. And what you've missed out on is a bunch of skills that you would have learned on the job, how to iron your shirt and speak nicely to customers and all those sorts of things. And you miss out on that. So so by raising the minimum wage, it's not always as nice as it sounds. You do leave people behind.
Yeah.
People, vulnerable people. Yeah.
That's part of the capitalist society to a degree, isn't it, John? Unfortunately.
Yes. So the idea in the free market is that prices give signals, and wages are a price. And it's the reason why capitalism leads to full employment most of the time is that you've priced everything the right way, including very skilled people and very unskilled people. And so yes, but what it does is, capitalism doesn't want to leave anyone undeployed. It wants to kind of get value from everyone. But if you're unskilled and there's a minimum wage, it's not going to. You've been left behind a little bit. Yeah.
Cool. All right. Good. I think there's a bit of economics 101. That's that's parked at, but I think we definitely straight. But I think it's a good discussion, basically, based on, because there has been a lot of concerns, or as you said, maybe it's a false alarm given the fact there's a lot of people playing politics out there, just to say don't do this, etc., etc. Or maybe unfortunately RPA governor at the moment, because he's probably got a couple more months to go, and it's just like, well, let me be on the headlines again, given the fact that I might not be re-elected, so I might as well say what I want at this point in time. Purely hypothetical. So, all right, let's get into some interesting data for June. How about that? So we've got the Corelogic data for June, which shows pretty much a sea of green at the moment.
It really does.
The national housing value has rose by 1.2% across a combined capital and regionals. Some of the most stellar ones, Sydney and Brisbane. Sydney has gone up 1.8% for the month, and Brisbane at 1.4% for the month, which is stunning, stunning. And again, look, I think we're both shaking heads, to be honest. But look, this is the main attribute to this, I still think, is the supply shortage, as we mentioned before. The supply shortage, we've both experienced it. There's actually a sense of FOMO that's lingering in the market at the moment. If you're one of those buyers that's been trotting to open inspections, you see a flood of people coming through, or people lining up to see inspections again. And the property's sold within a week or two, that's basically FOMO that I'm seeing in the market. It's not happening everywhere, but I guess from my observation, when I go to inspections, when I talk to agents, especially when agents kind of go, you might not see this property in the next inspection, so put in your best offer, whatever, right? So and look, in all fairness, that guy's right. The property sold in 1 week in that, and I think there's probably about 30 groups through in the first open as well. So that sense of FOMO at the moment is driven by low supply, and as we discussed, it's probably not going to change in a short period of time. Traditionally, winter is the quieter period as well, so that's not helping either. So I reckon I don't know. That's just hypothetically assume that interest rate's going to go up again next month. Do you reckon that the current trend that we're looking at for Corelogic is going to continue, John?
It's moving up very quickly. I'd be a brave. I mean, what I'm seeing is reflected in these numbers. I'm certainly seeing a lot of enthusiasm. It's actually a seller's market at the moment. So the buyers are chasing the market up, although the market is still down from a year ago. So it's relatively better value, I suppose. Do I think it'll continue though? Gosh. I mean, I know predictions are more interesting than retrospective.
I always ask you that right question, John.
I still think for the next couple of months, and I think that we'll probably end the year 9% higher than where we started. Okay. Given that we fell by 14%, I still think that by the end of the year we'll still be below the peaks, but mostly have erased it. So. But 1.8% a month, 2%, that's it's a lot. I mean, annualized, it's 20% growth, right?
Huge.
So so I don't expect that to continue.
Yeah. Okay. Any other particular highlights that you want to raise out of the June data pack that's worth discussing?
Yeah. So the only other thing, a couple of things actually. The main thing is that it's the upper versus the lower quartile where it's really interesting. So overall, we can see that let's take Sydney, and I don't mean to be too Sydney centric, but over the last quarter, Sydney property prices are up 4.5%. But the upper quartile, the premium end, the prestige end, that's up about 6% over the last quarter. So it's doing about 1.5 times the average of the city, and the lower quartile is doing about half the growth. So the lower quartile is doing about 2.6% growth of the quarter compared to 4.5% on average,
Hmm.
compared to about 6% for the upper quartile. So it doesn't necessarily mean yet that the rich are getting richer and all that sort of stuff. That, I guess, ultimately happens over time. But the upper quartile fell the hardest, fell the sharpest, fell first back in 2022. So in some respects, those markets are just playing a little bit of catch up. And the obvious markets there are the northern beaches and the eastern suburbs.
Yep.
They really got slaughtered at the beginning of the pandemic. Sorry, the beginning of 2022.
2022, yeah.
And they're doing really well. I mean, there are articles in the paper about some big eastern suburb sales. So that would be the first thing. The second thing is that houses are outperforming units.
Mm-hmm.
Now, this is not what I would have expected to see during a period of higher interest rates. So when interest rates go up, you normally see higher yielding properties start to come into favor. In the same way that when interest rates came down, houses became more attractive because they yield less. I would have thought the opposite would have happened, but actually houses are still outperforming units. And I find that strange. So the clearance rates tell a slightly different story. The clearance rates are saying units have a higher clearance rate by a small amount. But if you just look at the percentage growth, it's all about houses. So to give you an example of, let me give you Sydney again. Or let me give you the combined capitals. So overall, the combined capitals rose by 1.4%.
Yeah.
Houses went up by 1.5% and units went up by 1%.
Mm-hmm.
Sydney went up by 1.8% for the month. Houses went up by 2.1% and units by just over 1%. So houses are outperforming units. I wouldn't have predicted that. I would have thought that the higher yields and units would have sucked some of that cash in. So surprised to see that. And lastly, I would say that the rental market is still hot.
Yeah.
And and units are hotter than houses. So we can see that Sydney rents for houses for units are going up at 19.3%, Brisbane 16%, Melbourne 15.5%, Perth 14.7%. The only place where it's moderate to normal growth is Canberra at 1.5%. But unit rents are going crazy. Houses aren't quite the same, interestingly. So, if I look at Sydney's up at 9.5%, and the rent increases for units are double that. So, rents are going to stay high for quite a while.
And I don't think that's going to change within the immediate, right? Like we've got all these immigrants coming in. They all need a place to live. They either have to rent or they have to buy. So it's just fueling the competition, given the fact that our dwelling construction rate is also at the lowest in the record, I think, at the moment. So, yeah, unfortunately, I don't think for renters, I feel for you, but I don't think that that's going to change anytime soon, in honesty. So there's just going to continue to be a competition moving forward.
Yep, it's going to get worse.
Yeah, it's an unfortunate fact, which then would make, as we've been spoke about, the yield coming back, but yeah, unfortunately not good for CPI either. But the yield's looking a lot better across the board, which then would attract the investors coming back into the market. Hopefully. So, but yeah, look, you are right, John. I'm a bit surprised to see the houses still performing so strong at the moment. I would have thought that the affordability ceiling at the moment with the higher rates rises is actually coupling people from being able to purchase in that sense. But maybe I was wrong. It's just not one of those things that we would thought that it would happen logically, which comes back to why we say never, right? Like you think that logically this is what should be happening, but it's not always how it turned out to be the case. There's too many factors at the moment at play now, including international money potentially. There's a lot of international money that's coming in. Maybe that's fueling the premium markets and the upper end of market because they don't really need to borrow as much as we spoke about. So mortgage induction or affordability is less of an impact to them in that sense when they have a lot more money coming in, right? But the lower, the unit side of things and what I think, when people competing with units for Sydney, that is, most of the time they probably need to borrow to a level of degree, because we're talking about maybe the 600 to the 800 or even a mil. That price bracket is still relatively affordable for first home buyers, small families. They will need a mortgage in that case. So that's why again, I'm hypothesizing here. That's probably why the unit market hasn't performed as strong, because they are being impacted. That bracket is being impacted more by the affordability issue. In other words, they can't borrow as much. They've been hit by the borrowing capacity. Whereas for people who's able to play in the houses market, talking about Sydney, maybe a 2 mil, 3 mil, that kind of thing, they might not need to borrow that much. They got a lot more cash on hand, and therefore they can go a bit further or harder.
Yeah,
maybe.
No, absolutely. Look, and you raised something really interesting just then. You mentioned overseas buyers.
Yes,
such a good point. One thing we don't talk about enough is the impact of the currencies, the Australian dollar, on the attractiveness of Australian real estate to overseas buyers. And I can tell you that part of what kicked in when the Aussie dollar went below 70 cents, and now it's around 65 cents, I think maybe 66, is that overseas buyers started to get really interested in Australian property. So one of the things is we're seeing property prices go up and interest rates go up, and we can't quite connect the two. Part of it is because the dollar just made prices another 10% cheaper to overseas buyers, and so overseas buyers are certainly coming in, and I'm getting inquiry from people overseas as well. So that's interesting as well.
Yeah. Okay. Awesome. All right. Well, look, I think any other highlights that you think is worth mentioning from the June data pack, John?
No, I think we've picked out the big things.
Okay. All right. Well, I reckon that's pretty much a wrap then in that case for this week. I think there's a lot of chat about properties, which, we're just all trying to make sense out of what it means. But, it's like I said, at the moment, the property market is just such a fascinating story. Every week, every time when we get together, when the new data comes in, when you try to piece all these puzzles together, try to make sense of it, there's always something else that kind of jumps out. So
Well, real estate's a really emotional asset, and people love it. And even the people who are in a period of not buying, they're thinking about buying, or they're preparing to buy, or they're saving up to buy. So real estate's different to other assets, and it's where you raise your family. It's banks love real estate. So yes, it's going to go up and down, but it's always going to be an essential.
It's a national sport, as we always call it for Aussies, right? But hopefully it's not going to turn into an international sport, because it sounds like at the moment it's heading that way. So anyway, listeners, thank you for joining us for another week. And look, as always, do your own due diligence. Anything that we have spoke about here is general in nature. So please, if you are taking advice, please go and see your specific advisors before doing so. But otherwise, have a great week. And we will see you guys again in another episode of Spark Your Fire. Cheers, John and David.